Hi Moss 4472 team. In this video, I'm going to take you through chapter 10, which is our chapter on purchasing and payment processes. Let's get started. Let's take a look at the purchase and payment function. This function is closely tied to accounting because the payment and purchase process shows up not only in our balance sheet accounts in the form of both assets and liabilities, but also on our income statement accounts as cost of goods sold or some expenses that we have. So let's look at the various components of this process. We have the purchasing of material, inventory, and fixed assets. As we know, the purchase of material would include a very different process than the purchase of fixed asset. When I worked at Vale, we purchased a lot of capital assets and I was involved in the evaluation of the request for proposals. So what occurred was there was multiple vendors that were able to supply the machinery that we were looking for. So we sent them our RFPs and then they sent back their proposals and we needed to evaluate them. And we evaluated them not only based on quantitative factors, but also a lot of qualitative factors, looking at the reliability of the vendor, also the various specs on the machines that they were providing, was there any maintenance provided, etc., etc. So all those kind of things are involved in the purchase process of fixed assets. It's not that complicated to purchase inventory, especially if you have a long-term relationship with the vendor. Perhaps the vendor is even incorporated into your ERP system. Then we have our payment for purchases, and once again, our payment is very different for regular vendors that we have relationships with versus if we are making a big purchase. You would have probably much more approval for a purchase that costs over $1 million than purchases that are under the $1 million. Then returning goods and negotiating allowances if the goods are not, up to standards. How do you return them? Are you allowed to have some kind of allowance for returns? Then we have the selection of vendors that I spoke about a little bit earlier in the slide. If you don't have an initial relationship with a vendor, you have to go through a very important process because you want to make sure that the vendor you're building a relationship with is aligned with your business's purposes. A lot of qualitative factors that are used to evaluate vendors include their mission, their vision, their practices, making sure that they don't engage in any illegal practices. Apple got into a lot of trouble a few years ago, not because they were doing something wrong, but because some of the vendors that they were sourcing some of the rare earths that are used in iPhones were utilizing child labor. They had just atrocious work conditions. There were landslides, there was no safety, there was no safety equipment, workers were mistreated, and Apple received backlash, and that caused them to have a more comprehensive vendor management policy and vendor selection process to ensure that things like that wouldn't happen. I think the vendor was, the whole expose happened in the UK, so one of the UK major newspapers uncovered this. So it's really important to take the time to select the correct vendor. Then you're going to enter into contracts. This might involve accounting as well as legal to make sure that the contracts are beneficial to the organization. All the terms are thought about and you are ensuring that you have contingencies to all the risk scenarios that you look at. And then there's a process for placing orders. How are orders placed? Who places these orders? How do you ensure that the vendors that are selected are legitimate? How do you ensure that there's not multiple purchases for the same thing? Who's approving these orders? Etc., etc. So there's a lot of controls that need to go into the purchasing and payment function because it involves goods coming into the organization. So there's a potential for fraud there, but also payments or money going out of the organization. So you really need to make sure that you have very tight controls when it comes to this process. Now let's look specifically at the inventory purchasing process. The first thing you'll need to do is determine whether or not you need to purchase inventory and the amount that you need to purchase. Usually that requires a purchase requisition form. And then you go into your purchasing and vendor selection and management module, where you're going to request the availability and pricing if you utilize multiple vendors. If you have one relationship with a vendor and you have a contract price established, you would skip this step. But if there are multiple vendors that you have purchased as part, let's say for example, in the past, you would send them information, kind of like a mini RFP saying, we are looking for this, can you provide us a quote? So you obtain a price quote. If the quality is similar between the multiple vendors, then you are going to order the inventory from the lowest costing vendor. And this is the purchasing and placing orders process. And here you're generating a purchase order. Remember that generating a purchase order doesn't really have much to do with accounting because it's a promise. Neither money nor inventory entered your business, but when you receive your inventory, that's when you need to record that transaction. And you'll usually receive a receiving report. In this report, you will be told the goods that are within the container or box that you acquired, the purchase price, the quantity of the good. It is always prudent to verify your receiving report is accurate, and usually you want to do kind of a three-way reconciliation where you're looking at your purchase order versus your receiving report versus what you count on hand to ensure that everything is appropriate. Mistakes do happen, so it is really important to reconcile everything. And then once you have that inventory, you will either pay for it using cash or have an accounts payable that you pay at a later date. Those will be all terms that you have with various vendors, and you will proceed according to that contract or agreement. Let's discuss inventory a little bit more. So inventory is a balance sheet item that includes all items used in the creation of products. And if you have a manufacturing company, inventory can be classified into 3 different categories. We have raw materials, which are any components used in the creation of products. This is what you would be sourcing from another company. So for example, if I was a stainless steel manufacturer, one of the products that I would be purchasing to make stainless steel is nickel. So this would be raw material. Then we have work in process, and these are products that are still in the process of being manufactured, but they are not complete. And they're partially converted but they are not ready to be sold to customers. So for example, maybe you've incorporated some of the alloys to make stainless steel, but the product needs to harden, or you need to put in something else. So that is your work in process. And then finished good inventory are products that are ready for sale or to be shipped to customers, but that still belong to you. And the strategy for finished goods varies by company, and based on circumstances. One thing we saw during COVID is that the disadvantage of having just-in-time processes is that you do not have any buffer inventory. So when production stops, your sales have to stop as well, because you don't have anything in the pipeline. So inventory management is very interesting. I'm sure you've talked about it in other courses, but it's something to consider when you are building your accounting information systems, because you need to know which locations your inventory is held. If we were a merchandising business, then we would just have our purchases and they would all be classified as finished goods inventory, because you're just selling what you purchase from wholesalers or other vendors within your storefront or online store. Tell me what your thoughts are about service companies and the types of inventory that they have. Now we're going to discuss purchasing, and the purchase requisition involves into a legally enforceable purchase order. So with your requisition, you're trying to figure out what you need, and once you select your vendor and you have some kind of a contract, you create a purchase order. The purchasing agent transforms the purchase requisition, which is an internal company document, to a purchase order, which is an external document used to request a supplier to sell and deliver the products in the quantities and for the prices specified in the purchase order. So sometimes with purchase requisitions, you need various levels of approval depending on what you're ordering and what the limits are. So a purchase clerk usually doesn't have the approval to just purchase inventory. They might need to go to the production manager to sign off that yes, this is required by the business and we need to make this purchase. Once the supplier accepts the purchase order, that transaction turns into a legal contract where the supplier is bound to supply the goods or inventory to the organization. Now let's discuss receiving. This is a very important function that requires a lot of controls, because many companies experience theft when it comes to receiving. Therefore, this area should have restricted access. All receiving employees should have background checks. They should be trained on their work. Oftentimes there are some other security measures in the receiving department, such as monitoring cameras, so that in case theft occurs, it can be detected. So with receiving, when a supplier delivers an order, they will also issue a supplier generated packing slip, which you will use when you create your reconciliation and receiving report. And this packing slip will show the quantities, the descriptions of the items delivered or packaged, and it is issued to the receiving department at the specified warehouse location where the goods are shipped. The data then generates a receiving report, and this report will show the descriptions and quantities of goods received from vendors. So you have your packing slip from the vendor, and then you're creating a receiving report which counts all the products you receive and the name of the products, And then you will also need to have a discrepancy report that looks at the variances between your receiving report, your purchase order, and also your supplier generated packing slip to make sure that there are no incongruencies. Sometimes the wrong amount of goods are shipped. So if you are shortchanged, it's important to call up the vendor and say, you know what, we're missing a unit of this and 2 units of that. May you please reconcile it. And remember that theft can not only happen in the receiving department, but also in the shipping department. So these kind of reconciliations are very, very important. Now we are at the stage where the accounting department gets involved, and in particular accounts payable. So once the goods are received, in accounts payable, employees will enter the vendor invoices into the system. So this now generates an accounting transaction. The vendor invoice is a bill from the vendor that includes the related purchase order, billing date, description and quantities of goods, the amount due, as well as payment terms. So in this case, it is very, very important to look at the vendor invoice versus the receipts report versus the purchase order to make sure that everything reconciles and everything is accurate. Inventory management is very, very crucial to the purchases and payment process. And inventory management is the process that coordinates the communication of inventory available and needs across the purchasing, conversion, and sales processes. So inventory management incorporates 3 key processes, and it is critical to ensure that you are not missing sales, but also that you are not overbuilding your inventory. Efficient and effective inventory management is obviously critical to the success of any company, because it includes the utilization of working capital. And poor inventory management may result in either insufficient inventory, so your opportunity cost is lost sales, or excessive inventory where you are tying cash to goods. And this is always risky to have excessive inventory, especially in a day and time where product's half-life is very short, because if you have too much inventory of a certain product, perhaps a newer, better product will come along, and then you might not be able to offload that product, or you will need to sell it at a very, very discounted price. As I mentioned before in this presentation, inventory management is really, really an art. And you always have to be cognizant of the risks involved and how you're going to balance those risks as an organization. When I worked in Vale, during our budgets, we always looked at inventory management. And because we had shutdowns during the year, where our processing plants, our smelters, our refineries needed to be, basically maintenance needed to happen, cleaning needed to happen, we always built inventory during those times to ensure that we were still able to meet sales when those plants were not working. And then with inventory, what's interesting is who is the owner of the inventory? Is it the production facility, or is inventory management part of sales responsibility? This is more of a management control talk than an AIS system talk, but it's amazing how behavior is driven differently depending on who is the owner of the inventory and when that ownership transfers from one department to another. And this also should be reflected in your accounting information system, because obviously the owners of the inventory are the ones who are making the decisions of where it goes, and etc., etc. With inventory management comes supply chain management. And supply chain management processes oversee the life cycle of a product from procuring raw materials through customers' sales. It's a very collaborative effort between a company and its suppliers, subcontractors, transportation providers, distributors, wholesalers, and retailers. Basically, most of the stakeholders that the company works with. And the goal of supply chain is to produce and distribute a product or service to consumers efficiently and effectively by supplying goods and services at the lowest cost possible while providing the highest value to customers and other stakeholders. So while I was in Vale, I started in business planning and analysis and eventually moved to supply chain. And it was a very, very interesting role because you are dealing with so many stakeholders and so many departments. So in that job, I was talking to our production facilities all the time, because although we had a plan, things changed. So customer orders might have fallen through, or customers wanted more. We might have had some production issues. Also, we were dealing a lot with logistics to make sure that trucks were available to ship the inventory. We shipped internationally, so some of our trucks went from Sudbury, Ontario, all the way to BC, Vancouver, where the goods were loaded onto containers and shipped to China. While I was there, a new mine was being developed in New Caledonia. So one of the things we looked at in supply chain was, would it be more effective to send the ore from New Caledonia to China and then really focus our ore that we were mining in North America to other places, because transportation was so expensive. A lot of companies will purchase at least some of their own trucks in order to have control. Walmart is an example of a company. They have their own trucking fleets. They also have their own airplanes, just so they have the ability to make all the decisions and they don't have to rely on an external third party, but are able to take their products from their warehouses to their stores single-handedly. So it's really interesting whether or not organizations should do this. It all depends on what is their mission, what's their strategy, what's their competitive advantage, as well as what are their core competencies. The supply chain module in the AIS system is very comprehensive, and it always has to be very integrated, because you are dealing with not only so many internal company departments, but also external stakeholders. So this is a module that if you are integrating with other companies, usually you're going to do some integration into your supply chain module. When you are thinking about information systems, you always need to discriminate or distinguish between the physical flow of goods versus how information flows. So when we talk about physical flows, we are talking about the physical flows of inventories that are the most visible part of the supply chain and involve the storing, transforming, and moving of inventory, whereas our information flows require information technology that allows supply chain participants to coordinate their activities and control the daily flow of goods and materials along the supply chain. And with information flow, coordination is key. You need to make sure that all the stakeholders are on the same page and have access to the most timely information to make key decisions. We are going to look at how to evaluate the purchasing process, but before we do that, let's take a step back and think about what kind of information do we need to evaluate any type of process. So the questions that we would like to answer when evaluating processes include: what does that process look like? How does it work? And who does what? So with purchasing, what does the process look like? You'll always see internal and external stakeholders. Then you are going to look at how it works. So here you're looking at how is information communicated, how are goods purchased, and once you know that, you need to know who does the tasks that are involved in this process. Here you're going to look at who has the power to make purchase requisitions, who approves purchase orders, does the organization have a vendor list, who takes care of the vendor list. Once a vendor receives a purchase order, are there any negotiated terms? Who's working in the receiving department? Who's working in accounts payable? Do you have appropriate segregation of duty? These are some key questions and things you should think about when you're evaluating the purchasing process. As I mentioned earlier, fixed assets are a bit unique from inventory just because of the monetary costs associated with them. So let's define fixed assets before we start talking about them. Fixed assets include land improvements, buildings, equipment, and machinery that are used in production. You also have office equipment, computer equipment, furnitures and fitting, warehouse shelvings, and of course, vehicles. In financial accounting, fixed assets are generally known as property, plant, and equipment, or PP&E. The costs of acquiring fixed assets are referred to as capital expenditures or CapEx expenditures in the business world. And as I mentioned, they usually require a unique process due to the amount of money or investment associated with them. Let's look at a typical fixed assets business process. We have procurement, who is involved in assets purchases, and they're usually approved based on established approval limits. When it comes to fixed assets, oftentimes you will have some type of capital budgeting process that the organization goes through, because usually there's more capital expenditures needed than the amount of cash available to purchase them. So this is where your net present value analysis comes in handy, where you look at the investments available and what you are going to actually invest the money to. Once you get those assets, you have receiving and tagging. So the assets are received by someone outside of purchasing. As we talked about with inventory, you usually want a separate receiving department. You would like to have lots and lots of controls. And one of those controls is tagging the assets once you receive them so that they are identifiable and you have a record that they are within your company. Recording, this is where us accountants get involved, and we will record the fixed asset into the fixed asset subledger and into our accounting information system. Usually there's some kind of fixed asset reconciliation done. And this is where the financial accountant looks at the fixed assets monthly and independently reviews what the company has on the books versus what is on site. With fixed assets, because they have a longer term, there's going to be some depreciation unless, of course, you've purchased land. And depreciation will be recorded monthly into the fixed asset system and posted into our ledger. Once the useful life of the asset goes by and you're going to either dispose or transfer of the asset, you need to get approval from the various individuals in the organization involved in this. And you are making sure that forms are submitted with the tag and that the financial accountant records the disposal of the fixed asset. And usually you will either have a gain or a loss that also needs to be recorded. Fixed asset acquisition internal controls. Generally speaking, fixed asset purchases have the same risks and internal controls as the purchases of other goods. Material fixed assets, however, should be subjected to additional authorization to prevent unauthorized purchases. So this is where you have people with different purchase limits. If the purchase limit is high, you should have additional people signing off. Also, as I mentioned, you should have some kind of capital budget and purchasing plan to ensure that you are purchasing goods that the company actually needs the most and will yield the most return. Two additional risks that you need to consider when you're thinking about acquiring fixed assets are the overstatement of fixed assets in financial statements because of capitalizing expenses. The frauds that we talked about earlier on in class, especially WorldCom. One of the financial misstatements occurred because the company was booking period expenses as capital expenses. So you have to make sure that you select the appropriate form of depreciation for the asset and you utilize that. The other thing you need to be concerned about is bid rigging, and this is usually done by external vendors. You want to make sure you're getting a competitive price that is accurate and there's no either collusion between employees within your firm and that vendor, or the vendors aren't getting together and setting a high price. Now that we have acquired the goods, it is important to pay for them, and this is where the payment process comes in. The payment process is also known as the cash disbursement process, and it involves paying for the acquisitions or goods that you acquired or purchased during the purchasing process. And the payment process impacts the amount of cash, which is the most liquid asset on our balance sheet, by decreasing the cash balance. So when we make payments, we reduce the amount of cash. So your payment cycle is part of your cash management cycle, and it's a very important cycle. And I'm sure if you talked about this in audit, you notice that payments and cash are very closely related, as well as your receipts or accounts receivables and cash. So the two primary methods for paying for purchases are cash payments or using credit. Payments made using credits are recorded in your accounts payable, which is an account that records money the business owes to its suppliers and vendors. Cash is highly susceptible to fraud and theft, and fraudulent disbursement schemes are common. So that's why I kept mentioning, make sure that the vendors are legitimate. One of the greatest fraud risks in the payment process is employees creating fictitious vendors and sending fraudulent payments to accounts the employee controls. So employee is stealing from the company by creating these vendors. So it's important to make sure you have an accurate vendor list and you do all those reconciliations. Here's our enterprise resource planning system that we looked at before. Last week we looked at our HR process. Here we are looking at our purchasing process. We have our supply management module that has purchasing, shipping and receiving, as well as inventory. And then our financial modules also involved because of the recording of payments or accounts payable, as well as owning some fixed assets. Thank you. I hope you found this presentation helpful. And if you have any questions about our purchasing and payment process, please feel free to ask me. Take care. Bye.